Share-based payments. The accounting standard IFRS 2 on share-based payments is very much designed with the accruals concept in mind. For example, share options can take the form of employee remuneration with a requirement that the member of staff must work for the entity for a number of years before receiving their shares. This length of time is known as the vesting period, and as there is no physical transaction over this time, there is nothing to trigger expense being recognised in the financial statements in respect of the benefit received from staff. Therefore, IFRS 2 ensures that expense is recognised each year in respect of the benefit received from staff. For each year of the vesting period, expense is recognised. The corresponding entry is based on whether the member of staff is receiving shares, known as equity-settled share-based payments, or cash, known as cash-settled share-based payments. If the member of staff is receiving shares, then an equity reserve is built up over the vesting period. And if the member of staff is receiving cash, then a liability is built up over the vesting period. Before we see the details of these treatments, it is worth taking a moment to consider the impact that each of these schemes will have on the gearing of the company. A cash-based scheme will increase the gearing through the creation of the liability, and if the amount is significant, this could impact on assessment of risk. Predominantly in this session, we will discuss the use of share-based payments as staff remuneration, but it is important to note that other goods or services can be purchased using shares. This may be an attractive option if the cash resource in the business is low. The accounting is straightforward. If the value of the goods being purchased are $90,000 and the nominal value of the shares issued is $70,000, then the balancing entry is recorded as share premium. Equity-settled share-based payments. A typical share-based payment scheme would have a vesting period of, say, 3 years. Therefore, the expense associated with the scheme would need to be recognised over a 3-year period. If a member of staff were to leave before the end of the 3 years, they would forfeit their right to the shares. Therefore, we only need to recognise expense in respect of those members of staff that will remain in 3 years' time. This involves working with the human resources function to determine how many staff will be left at the end of the vesting period. On a 3-year scheme, at the end of year 1, we can estimate this number by using actual leavers for year 1 and predictions of leavers for years 2 and 3. At the end of year 2, we can use actual leavers for years 1 and 2 and predictions for year 3. At the end of year 3, we will know actual leavers for all 3 years and therefore can use this actual data. We are therefore basing the total expense on our predictions of who will be left at the end of the 3-year period and recognising a third of this each year. The other aspect of this measurement is to actually assign a value to the share option. This is done at the grant date, which is the date on which the member of staff is initially granted the options. Once set at the grant date, the fair value of the share option remains static and is used throughout the 3-year period. In reality, the valuation of share options is complex and specialised, involving option valuation models such as Black-Scholes and binomial models of calculation. Such models, of course, take into consideration factors such as share price, exercise price, volatility, risk-free rate of returns, dividends, and expected life. Once set at the grant date, the value of the options is not updated for the following reason. Imagine a share trading at £10 doubles its value so that in the following year it is trading at £20. It could be argued that the fair value of the share option should be doubled as well. However, if we went down this route, it would involve recognising twice the level of expense in year 2, and effectively, we would be saying that we had received twice the level of benefit from our staff. It is true to say that staff would not work twice as hard if the share price doubled, and that it is not possible to measure what percentage staff would work harder in correlation with movements in share price. Therefore, to avoid these ambiguities associated with the measurement is made at the grant date, and the value of the option is kept static, and it is not updated throughout the vesting period. Let's now see these mechanics in operation with an example. An entity grants 100 options to each of its 500 members of staff. There is a 3-year vesting period, and the fair value of the options at the grant date is 20. At the end of year 1, 30 members of staff have left, and it's predicted that a further 20 will leave during the vesting period. At the end of year 2, a further 40 members of staff have left, and it's predicted that a further 10 will leave. At the end of year 3, in addition to the 30 leaving in year 1 and 40 leaving in year 2, 20 members of staff leave, taking total leavers over the 3 years to 90, with 410 members of staff remaining. Each year, the required equity reserve has to be calculated. In year 1, this reserve is based upon the 30 members of staff who have left and the 20 future anticipated leavers. The reserve is therefore being calculated based upon 450 of the original members of staff remaining at the end of the vesting period. Each of these staff receive 100 options. The fair value for the share option at the grant date is 20, and this remains static and is used throughout the calculation. Having now calculated the total anticipated expenditure, 1/3 of it is recognised in this year. This gives an equity reserve of 300 and an expense of 300. In year 2, the number of staff is updated. We know that of the original 500, 30 have left during year 1, 40 have left during year 2, and it is anticipated that a further 10 will leave. This would take total leavers to 80 over the 3 years, and therefore the equity reserve is adjusted to be based upon the remaining 420 members of staff, each receiving 100 options. Notice that the fair value of the share option remains static, and that we now need to recognise 2/3 of the total anticipated expenditure. The equity reserve needs to be 560, and we would need to recognise expense of 260 to achieve this, given that we already have 300 of reserve in place. In year 3, we can see that the staff numbers are updated. This time, we can use actual leavers for year 1 of 30, actual leavers for year 2 of 40, and actual leavers for year 3 of 20. In total, therefore, 90 members of staff have left, and the reserve is based upon the 410 members of staff remaining. The reserve needs to be adjusted to 820, an increase and thus expenditure for the year of 260. Cash-settled share-based payments. There are 2 main differences between equity-settled and cash-settled transactions. The first is that rather than build up an equity reserve each year, a liability is built up instead. This is because there will be a physical cash payment at the end of the vesting period, which meets the definition of a liability. The second difference is that the fair value of the liability is updated on an annual basis. If a member of staff was entitled to receive the cash equivalent of the share price, then if the company's share price increased from £10 to £20, the company would have to pay out twice as much cash. Unlike an equity-based scheme, this is not difficult to measure. There is a direct correlation between the movement in share price and the liability. Therefore, the liability is updated on an annual basis. Let's now see how a cash-based scheme is accounted for. In this example, we'll use the same set of data as the previous example, only this time we'll assume this is a cash-settled payment, so the member of staff received the cash equivalent of the share price. Each year we will see a liability build up on the balance sheet, and this liability will be based upon an annual update to fair value. Notice that rather than use the value of the option at the grant date, the calculation uses the share price as at the end of each year. So we see a share price of 25 being used in the year 1 calculation, a share price of 30 being used in the year 2 calculation, and a share price of 35 being used in the year 3 calculation. This update to fair value has resulted in an overall increase in the expense being recognised. The mechanics, however, remain the same, in that at the end of the year, we require a liability of 375 and therefore charge expense of 375. At the end of year 2, we require a liability of 840 and therefore charge expense of 465. And at the end of year 3, we require a liability of 1435 and therefore charge expense of 595. Choice. We will now move on to think about the required accounting entries where there is a choice between an equity-based scheme and a cash-based scheme. The accounting treatment will depend on who actually has the choice. If the choice is that of the entity, then the transaction is treated as an equity-based transaction unless there is a present obligation to settle in cash. This obligation could exist in two situations. Firstly, if there is a past history of the entity having given cash, as this creates a valid expectation that staff can receive cash. And secondly, if the equity option carries no substance. In other words, if the company is not able to issue shares for any reason, the equity option would carry no substance. If, however, the choice is that of the member of staff, otherwise known as the counterparty, the scheme is accounted for using split accounting for compound financial instruments. The company does not know if it will have to pay cash or issue shares, and this is exactly the issue that exists with convertible debt, which is another area where we see split accounting applied. Let's now see an example of how to apply split accounting. In this example, assume that a member of staff can either have 1,200 options or 1,000 phantom shares, in other words, the cash equivalent of the share price. The shares at the grant date are trading at £50, and the fair value of the share option is 48. Potentially, the entity has to stand ready to honour an obligation of 1,000 times 50, equaling £50,000. Given that equity is a residual interest and 1,200 options times 48 is 57,600, the residual interest after deduction of the liability is 7,600. Therefore, 7,600 will be treated as an equity-based scheme and the 50,000 as a debt-based scheme. On the equity-based scheme, the fair value of the share options remains static, and if we assume zero levers, the total expense will not alter. Therefore, if we recognise a third of this expense each year, we will see expense of 2,533 each year, with the equity reserve increasing to 2,533 in year 1, 5,067 in year 2, and 7,600 in year 3. For the liability element of the scheme, we will base the figures on the 1,000 phantom shares, but update the fair value of the liability on an annual basis. Whilst the share price at the grant date was 50, it changes to 52 at the end of year 1, 55 at the end of year 2, and 60 at the end of year 3. The liabilities of 17,333, 36,667, and 60,000 reflect these updated fair values. Ultimately, then, we have created a liability of 60,000 and an equity reserve of 7,600. The treatments that follow after this will depend on how many staff opt for the shares and how many staff opt for the cash. There are some other areas to give consideration to. Length of the vesting period. The length of the vesting period could alter as we move throughout a scheme. For example, if the vesting period is based upon hitting a target growth rate, we could see a 2-year scheme if the higher growth rate is achieved, and a 3-year scheme if the lower growth rate is achieved. At the end of year 1, it looks as if the higher growth rate will be achieved, and therefore a 2-year scheme is in place. At the end of year 1, therefore, half of the total anticipated expenditure is recognised. However, year 2 is a poor year, such that at the end of year 2, the company has not met the higher growth rate target. The scheme is now a 3-year scheme, and at the end of year 2, we would recognise 2/3 of the total anticipated expenditure. The accounting entry required in year 2 is the amount to bring the scheme up to the cumulative 2/3 position. Market and non-market conditions. Sometimes a scheme will include a performance condition such as target growth rate, length of service, or growth in earnings per share. As we have seen in the examples, these will impact on the level of expense being recognised. For example, if a member of staff leaves before the end of the vesting period, we stop recognising expense in respect of that member of staff. If, however, the performance condition includes hitting a target share price, then we would not consider this as part of our calculations. This is technically known as a market condition and is one of the things that is taken into consideration when calculating the fair value of the share option. For example, if the company stood a high chance of hitting the target share price, then the fair value of the share option would be high. And if the company stood a low chance of hitting the target share price, then the fair value of the option would be low. As this consideration has been built into the fair value of the option, we do not adjust expense in respect of hitting or not hitting the target share price, as this would result in double counting. Cancellations and settlements. It could be that the share scheme is either cancelled or settled early. Where this happens, rather than the expense being recognised over the remaining vesting period, the expense is recognised immediately. This is sometimes referred to as acceleration. Lapsing. Lapsing is where the minimum vesting period has been complied with, but the member of staff does not wish to exercise their options. This could happen if the share price is below that of the exercise price. Given that the member of staff has worked for the required vesting period, and the company has therefore received benefit from that member of staff, it would not be appropriate to reverse out the expenditure recognised, as the company has received benefit and therefore incurred expense. Instead, the equity reserve that has built up is simply recycled to another component of equity. In other words, the reserve is no longer needed, as shares will not be issued, and it is simply transferred into retained earnings. Deferred tax. In simple terms, a share-based payment creates a deferred tax asset, as the company will be entitled to tax relief against their future tax profits. The relief is granted in the future, when the shares are actually issued, rather than now, when the expense is recognised under the accruals concept. Hence the asset for the future reduction in tax liability. The size of the deferred tax asset is based upon the intrinsic value, which is the true cost to the company. In other words, this is the share price less the exercise price, and that's the actual cost to the company. The deferred tax asset is built up over the vesting period. With regard to the double entry, there is a debit to the deferred tax liability, and there is a corresponding credit entry. To the extent that this reverses previous expenditure on the share-based scheme, the credit entry is recorded in the profit and loss account. However, any excess is recorded as a credit entry to equity. Let's take a look at an example to see how this would work. In this example, let's assume that there are 1,000 options vesting in 2 years' time. The fair value of the option at the grant date is 5. The cumulative accounting expense recognized in year 1 is 1,000 options times 5 times a half, equaling 2,500. The cumulative accounting expense recognized in year 2 is 1,000 times 5 times 2 over 2, which equals 5,000. In post-tax terms, assuming a rate of 30%, the cumulative expense is therefore 750 at the end of year 1 and 1,500 at the end of year 2. The deferred tax asset that can be set up in year 1 is the intrinsic value of 2.2 times 1,000 options times 1 over 2, as we are halfway through the vesting period. This gives a total of 330. This does not exceed the cumulative post-tax accounting expense of 750, and so the credit entry for setting up the deferred tax asset can be taken through the profit and loss account. In year 2, the size of the deferred tax asset increases to 1,950, based upon an intrinsic value of 6.5 times 1,000 options times 0.3, and this equals 1950. This exceeds the cumulative amount of post-tax accounting expense, and therefore the excess will need to be credited to equity. In year 2, therefore, the deferred tax asset needs to increase by 1620. We can only credit a further 1170 to the income statement, given that the maximum was 1,500 and we used up 330 of this in year 1. Therefore, the excess of 450 is credited to equity. In summary, therefore, the journal required in year 1 is debit deferred tax asset 330, credit income statement 330. The journal required in year 2 is debit deferred tax asset 1620, credit income statement 1170, credit equity 450.